All right, we back. Hey, give yourself every advantage possible if you're going to learn how to trade. Trading is not hard, but it is hard to execute. It's not hard to see what you need to do. Okay, I always talk about the analyst inside of you versus the trader inside. Two different animals. The analyst, you can already see what's about to happen. Okay, I'm going to show you a couple trade setups and different ways you could have seen what happened on Friday and traded it and kind of understood where the target was going to be and using the T levels system. Okay, this is just basically the ideal reason I like T levels is because it's very flexible. You can use a lot of different trading styles with it, but it gives you all the information that you really need. So if you were going to get set up with it, it's a free trial in the description, 7 days. Use the link, go join the Discord, and get started using it. And then every so often, I'm going to do videos where we're going to teach concepts on how to take these trades, why we're taking the trades. So first one we're going to talk about is using your your sister indices. Okay, you got your S&P 500, then you got your Nasdaq, and you got your you got RTY. I typically, I don't like to trade the Russell futures very much. So I'm usually just in the S&P or the Nasdaq, and I'm really usually just in the S&P. But what you can see here, so this is just going to be the first setup where we're using both indices sort of as extra confirmation. First, you always want to make sure that your candles, the price is trading above these ribbons or these clouds. Okay, so I'm just sitting here on a 5-minute. The 5-minute seems to just be the best one for me for trading scalps or trading bigger trends. I don't like trading the 1 minute; it's a little too choppy for me. But some people might want to trade the 1 minute, so it's up to you how you want to do that. You could trade the 30-minute if you wanted to. But here's the deal. Right here, you can see the divergence, the bullish divergence. Okay, the first thing you see, right? Just by the way, I have the chart laid out. First thing you see is this bullish divergence. Why is it bullish divergence? Well, because this high right here, let's just see, as a percentage, so 0.66 as a percentage versus the S&P 0.2, and that's not even that was generous, wasn't it? If we're talking low to low. So you can see the divergence here. This NQ makes its low up here in this little consolidation. Okay, so they're consolidating it right there. That's where they end up making their low. That right there is a bullish divergence on the NQs. And so if you're trying to get long one of these, which one would you go long? This one actually on its consolidation, after they had a couple shakeouts here, these shakeouts, this was right at the consumer sentiment and Michigan inflation. So it was just like a quick wick. And I think those wicks are basically, when I see a wick like that, I'm already bullish. All right, but there's just been watching for a long time because I already kind of understand what's happening when they do that. They're just clearing, they're just sweeping liquidity. They're taking out all the stops. They're just like wiping the board. And I like that. I like seeing that because I can kind of get a fresh start looking for patterns because I know that a lot of positions were just taken out. So people are going to start repositioning. And I think people wanted to get long. But that's just my assumption because I've looked at because I look at the gamma charts and I do a lot of research before the market starts just to try to understand where I think the market's going to end up. And then when it comes into executing, you got to look for the patterns, you got to look for the divergences, you got to look for confirmations, that kind of thing, in order to execute. So that's what I say. The analyst's different than the trader. So you got to kind of wear two different hats. But anyways, we're looking at the bullish divergence here versus S&P. And you can see that Nasdaq sort of took off. Let's just mark the times here because we can see that Nasdaq kind of took off a little bit earlier. So you can see you could probably start getting long like right about here. So what is that, 1110? Let's see where 1110 is here. So you can see that the signal is way clearer on Nasdaq. You can see right when the cross happens where the bearish volume essentially crosses over with the bullish volume. Okay, that's a great sign. You see the candle, it closes above the ribbon, above the cloud. Okay, great sign. You don't have the confirmation from your sister indice essentially, but that's okay, because that's why you bought NASDAQ here, because NASDAQ is bullish and it's leading. It's the leader right now. So you get into NASDAQ, and then as soon as this starts getting a little bit bullish for folks, that's when NASDAQ starts to really take off. And you can see right where it goes. This resistance was already on the chart for you. Okay, this was already here. You don't need to worry about it. But again, you can also see another divergence here that I would point out, is that this didn't quite make it to its respective resistance. This did. This tried to actually break through, and it couldn't quite, just because it's the end of the day. But that's another thing. If you went long S&P and you see the NASDAQ hitting resistance, well, S&P was lagging. So is the S&P going to be able to break this level here and reach up? That would be a stretch unless this broke through. Okay, you can see how using the two together, using the ribbons, the bands, the multiple time frames, the breadth indicator. I mean, we had bullish breadth pretty much the entire day, so there's really not too many things that were in favor of the bears, especially given that most of the puts that expired, most of the options that expired were puts. So, and that's another reason, if you're a gamma student at all, you already know that end of the day is likely to be a squeeze, just because all the puts are going to be expiring. So that's essentially what the setup was. Another way to look at this, and this is something that I learned from studying Mark Minervini. He's sort of a trend trader, but the concepts still apply on a fractal basis. He always talks about this volatility contraction pattern. Okay, it's the same thing here. All this shakeout, everything that's happening right here in these little areas is volatility contraction. Okay, every time it you get a volatility spike down, and then it contracts. Okay, then they bring it up, spike down, and then it contracts, and then they bring it up. Eventually, that volatility essentially just gets suppressed. Okay, and that's what releases the hatches, as you say, because here everybody's buying because they see the divergence or they see the moving averages in their favor, and then at the same time you get the short covering. So this is where the real profits are being made. So another way to look at it, if you know about those type of concepts, and there's other ways to sort of identify a daily move, but this is the easiest way, is kind of putting them together, looking at them, seeing the divergences, picking which one you want to go with, and picking your entry point, and essentially being the analyst, and then go into execution mode. Okay, because execution mode is going to be different. Execution mode, you're trying to get the best fill, you're trying to figure out your target, you're trying to set your stop, and I would go back to another video that I did about how to set your stop using the ATR of the day, and that way you could set your stop in a good reasonable place, like Forex traders would do. And then so hopefully you like this. If you do, 7-day free trial in the description, and go check it out, and we'll see you next time. Peace.